March 2026. Emaar Properties shares sit 47% below their 2023 peak. Net profit has declined 7 consecutive quarters. Foreign institutional ownership has hit its lowest level since 2018. 7 consecutive quarters of decline. During what Dubai is still officially calling its greatest real estate boom in history. When a company bleeds that consistently during a boom, you are not looking at a bad cycle. You're looking at a structural collapse the boom was temporarily hiding. In 2026, there's nothing left to hide behind. January 2024. A drone launched from Yemen crosses 1,500 kilometers of open desert and strikes a commercial building in Dubai's Dira district. No casualties, minor structural damage, but the markets didn't care about the damage assessment. They cared about what it meant. Emaar Properties, the company that built the Burj Khalifa, that invented downtown Dubai, that turned a sandstorm into a skyline, watched its share price drop 6.2% in a single session. In 2 weeks of Houthi escalation, Emaar shed over 8 billion dirhams in market capitalization. Read that again. 8 billion dirhams gone. Not from a failed project, not from a bad quarter, from a drone. But the drone didn't break Emaar. It just revealed what was already there, a company that had spent 2 decades constructing the most audacious bet in real estate history, that the Middle East could be made safe enough, stable enough, and wealthy enough to become the world's next permanent luxury address. That bet is now being stress-tested by the most violent regional conflict in a generation. To understand what Emaar is, you have to understand what Dubai was in 1997. It was a city of 900,000 people, a functioning port, and a sheikh with a vision that most Western financiers privately described as delusional. Mohammed Al-Abar understood that vision. He had spent years studying retail and development in Asia and returned to Dubai with a singular conviction that if you build something extraordinary enough, the world will come to you. Emaar Properties was incorporated in 1997 with an initial capital of 1 billion dirhams. The Dubai government held a controlling stake. The mandate was not subtle. Transform Dubai into a global destination through real estate development at a scale no private company had ever attempted in the Arab world. What followed was not construction, it was alchemy. And Emaar built the Dubai Mall, the largest shopping mall in the world by total area. It built the Burj Khalifa, the tallest building on Earth, 828 meters, 163 floors, visible from 95 kilometers away. It built downtown Dubai, an entire city district, 500 acres, conjured from desert in under a decade. By 2010, Emaar had delivered over 26,000 residential units in Dubai alone. By 2023, the company had expanded to 36 countries, with active projects across Egypt, India, Pakistan, Turkey, Saudi Arabia, and Morocco. In 2023, Emaar reported a net profit of 9.9 billion dirhams, a 21% increase year over year. Revenue hit 26.6 billion dirhams. It was the most profitable year in the company's history. Sales backlog, future revenue already contracted, stood at 70 billion dirhams. The machine was not just running, it was accelerating. Then Hamas launched its attack on October 7, 2023. Before the war, Emaar's geographic footprint looked like a portfolio built for dominance. Egypt, Saudi Arabia, India, Turkey, Pakistan, Lebanon, Jordan. Each market carefully selected for demographic growth, urbanization pressure, and a rising middle class hungry for the kind of aspirational luxury living that Emaar had perfected in Dubai. It looked like diversification. It was actually concentration. Concentration in a single geopolitical zone that history has never once kept quiet for long. The company's Egypt operation, Emaar Misr, represented one of its most significant international bets. Cairo's New Cairo district hosted multiple Emaar master plan communities. Uptown Cairo, Madinati in Partnership, Mivita. These were not small projects. Mivita alone covered 4 million square meters. Uptown Cairo was designed as a self-contained city on the Mokattam Hills with its own retail, schools, and a golf course. By late 2023, Egypt was in full-blown currency crisis. The Egyptian pound had lost more than 50% of its value against the dollar in 18 months. Emaar Misr's revenues, denominated in pounds, were being repatriated as a fraction of their original dollar value. A unit sold for 5 million Egyptian pounds in 2021 was worth less than $100,000 by 2024. Buyers who had purchased in dollars, many of them Gulf investors, were watching their asset values collapse against their financing costs. In Saudi Arabia, Emaar had aligned itself directly to Vision 2030, the kingdom's $500 billion modernization program, the Jeddah Gate project, Red Sea-adjacent residential communities, the partnerships with NEOM adjacent development corridors. These were not speculative bets. These were sovereign-backed mega projects that carried the full weight of Crown Prince Mohammed bin Salman's personal credibility. And then the region caught fire. October 7, 2023 did not just start a war in Gaza. It triggered a cascading regional realignment that hit every single market Emaar operated in simultaneously. Here is what happened to Emaar's geography in the 6 months following October 7th. Egypt activated emergency protocols and saw tourist arrivals, a key driver of luxury real estate demand, fall 12% in Q4 2023. The Rafah crossing situation created a political environment where Egyptian elites began quietly moving capital offshore rather than investing domestically. Emaar Mizr's sales velocity slowed. New launch schedules were pushed. Jordan, where Emaar had the Abdali Boulevard development, a $5 billion mixed-use project in central Amman, saw street protests that lasted weeks. The Jordanian dinar held. The political environment did not. Foreign investment inquiries dropped. The Abdali project, already behind schedule, entered another period of uncertainty. Lebanon had already effectively collapsed before October 7th. Emaar's Lebanese assets, including a significant hospitality footprint, were largely stranded, but the escalation of Hezbollah-Israel exchanges along the southern Lebanese border through late 2023 and into 2024 converted a frozen asset into an active liability. Insurance costs surged. Management personnel were relocated. Turkey, where Emaar had built over 2,500 units and maintained an active sales pipeline, was not at war, but it was managing the political consequences of positioning itself as a mediator, which made it simultaneously useful to every party and trusted by none. Foreign buyer appetite in Istanbul, which had been Emaar Turkey's primary market, contracted as European and Gulf buyers recalculated regional risk, and Pakistan, where Emaar had committed to Canyon Views, a major residential development in Islamabad, was experiencing its own political implosion, entirely disconnected from the Gaza conflict, but catastrophically aligned with it in timing. Every single geography at the same moment, moving in the wrong direction. Here's what Emaar's defenders will tell you. Dubai is different. Dubai is insulated. Dubai has the world's best performing real estate market in 2023 and 2024. They are not entirely wrong, but they are missing the mechanism. Dubai's real estate boom of 2022 to 2024 was driven by three specific buyer pools. Russian HNW is relocating capital post-sanctions, Indian ultra-high net worth investors diversifying internationally, and Western digital nomads and remote workers attracted by zero income tax and a functional infrastructure. Each of these pools is real. None of them is permanent. Russian capital flows into Dubai began to slow in 2024 as sanctions enforcement tightened and Western financial institutions increased correspondent banking scrutiny on UAE-routed transactions. The Financial Action Task Force had placed the UAE on its gray list in 2022, a designation that wasn't lifted until February 2024, and which had introduced friction into every major transaction crossing UAE banks. No, Indian buyers remained strong, but were increasingly channeled into specific submarkets, Creek Harbor, Dubai Hills, rather than Emaar's premium downtown inventory, where price per square foot had reached levels that compressed yields below 4%. And then came the Houthi drone campaign. Between November 2023 and April 2024, Houthi forces conducted over 45 attacks on commercial shipping in the Red Sea. Insurance premiums for vessels transiting the Bab el-Mandeb Strait increased 400% in 3 months. Maersk, MSC, and Hapag-Lloyd rerouted dozens of container ships around the Cape of Good Hope. Jebel Ali, the port that is the logistical spine of Dubai's entire import economy, saw throughput disruption for the first time in its modern history. Dubai did not get hit by a missile, but it felt the economic shockwave of a war being fought 1,800 kilometers away. And Emaar, as the single largest private employer and land developer in the emirate, felt it first. Emaar's business model has one structural feature that made it extraordinarily powerful in a bull market and extraordinarily exposed in a crisis. It sells units before it builds them. Off-plan sales, the practice of selling apartments and villas that exist only on a master plan, generated 73% of Emaar's residential revenue in 2023. Buyers pay a deposit, then installments tied to construction milestones, then a final payment on handover. Emaar receives cash up front, funds construction, delivers units, and recognizes revenue progressively. This model works perfectly when buyer confidence is high, construction costs are stable, and the macroeconomic environment is predictable. When any of those variables shifts, the model becomes a trap. Construction costs in the UAE increased 18 to 22% between 2022 and 2024, driven by steel price volatility, labor cost inflation, and supply chain disruption linked directly to Red Sea shipping rerouting. Projects that were costed and priced in 2021 to 2022 were being built in a 2024 cost environment that bore no relationship to the original assumptions. In Egypt, construction costs denominated in local currency were rising faster than inflation itself, 35% year over year in some categories, while the revenues from sold units were fixed at launch prices in a collapsing currency. In Q1 2024, Emaar's net profit fell to 2.07 billion AED, down from 2.4 billion AED in Q1 2023, a 13.7% decline. Not catastrophic in isolation, thus alarming in context. This was happening in the middle of Dubai's supposedly hottest real estate market in decades. The backlog held, the sales numbers held, but the margin compression was real. It was structural, and it was getting worse. By mid-2024, something had shifted in how institutional investors were writing about Emaar. The language changed. Resilient became selectively exposed. Diversified became geographically concentrated in conflict-adjacent markets. Analysts who had been bullish for 3 consecutive years began inserting paragraphs about geopolitical risk that hadn't appeared in their previous reports. EFG Hermes cut its target price for Emaar twice in 6 months. Goldman Sachs moved the stock to neutral, with a note citing elevated uncertainty across key international development markets. Morgan Stanley flagged Egypt currency exposure as a material unquantified risk in a research note that circulated widely among Gulf institutional desks. Foreign institutional ownership of Emaar shares, which had reached a post-pandemic high of 16.4% in early 2023, declined to 11.8% by Q3 2024. That is not a rounding error. That is 4 to 5 billion dirhams in institutional capital, quietly heading for the exit without a single press release. The retail investors, the small Dubai-based shareholders who had held Emaar through every crisis since 2008, stayed. They always stay, until they don't. Emaar's relationship with Saudi Arabia was supposed to be its salvation narrative. Mohammed Al-Abar had positioned the company as a natural partner for Vision 2030, a construction and development powerhouse that could help the kingdom build the cities MBS had imagined on PowerPoint slides and architectural renderings. The Saudi bet was enormous. Emaar had announced partnerships and memoranda of understanding covering billions of dollars in planned development across Riyadh, Jeddah, and NEOM-adjacent corridors. The logic was sound. Saudi Arabia was spending. Emaar knew how to build, match, made. But Vision 2030 had a problem that no one wanted to say out loud. It was being built on an oil price assumption that the war economy was actively disrupting. The Gaza conflict had not crashed oil prices. In fact, geopolitical risk premiums kept them elevated. But the secondary effects of regional instability, the cost of maintaining military readiness, the diplomatic capital being spent managing relationships simultaneously with the US, China, Iran, and a dozen smaller actors, were creating fiscal pressures inside the Saudi budget that were showing up as project delays. NEOM, the $500 billion linear city that was supposed to redefine human habitation, began quietly scaling back. The linear city concept was revised downward from 170 kilometers to 2.4 kilometers of initial build. The workforce projections were cut. The 2030 completion target was extended indefinitely. Consultants who had been hired at enormous expense were let go in waves through 2024. Emaar's Saudi pipeline, which had looked like a decade of guaranteed revenue, suddenly required renegotiation. Contracts that had been agreed in principle became under review, timelines extended. Capital allocation decisions moved up the royal chain and stayed there. As of early 2026, Emaar has not collapsed. Let that be precise and unambiguous. The company is still operating. The Burj Khalifa still stands. The Dubai Mall still draws 100 million visitors a year. New project launches in Dubai Hills and Creek Harbor are still selling. The company has not issued a profit warning. It has not drawn down emergency credit lines. It has not approached sovereign restructuring, but the metrics are moving in one direction. Share price down 19% from its 2023 peak. International revenue contribution declining. Egypt operations effectively in a holding pattern, pending currency stabilization that has not arrived. Saudi pipeline repriced and delayed. Insurance costs on all regional operations elevated. Institutional ownership in structural retreat. Net profit margin compression accelerating from 37.2% in FY 2022 to 31.4% in H1 2024. Mohammed Al-Abar, who had spoken at every major investor conference with the quiet confidence of a man who had already won, began choosing his public appearances more carefully. The interviews became shorter. The forward guidance became more hedged. The signature line, "We build cities," remained, but the cities being built were fewer, slower, and more expensive than the ones the company had promised. Emaar has 12 billion dirhams in cash and liquid reserves. It has a 30-year track record of surviving crises that killed smaller developers. It has the backing of the Dubai government and, implicitly, the UAE sovereign wealth apparatus. These are not trivial advantages, but it is navigating a regional war it cannot control, in a geopolitical environment it did not model, with a balance sheet optimized for peace. Buried beneath the institutional analysis and the analyst downgrades is a population of several 100,000 individual buyers across Egypt, Jordan, Pakistan, and the UAE who purchased Emaar units on payment plans and are now facing a reality the brochures did not describe. In Egypt, buyers who signed contracts in Egyptian pounds in 2021 and 2022 are being asked to complete payments at exchange rates that have effectively increased their total cost in real terms by 40 to 60%. Some have defaulted, some have renegotiated, some are in litigation. Emaar Mizr's customer service infrastructure, built for a market growing 15% per year, is not equipped for a market and currency collapse. In Pakistan, where the rupee lost over 60% of its value against the dollar between 2021 and 2024, buyers in the Canyon Views project faced a similar arithmetic nightmare. Units priced in rupees against dollar-denominated land and construction costs meant either the buyer absorbed the loss or the developer absorbed the loss. In practice, both absorbed it. Neither party to those contracts got what they were promised. In Dubai itself, off-plan buyers who purchased in 2021 at what seemed like high prices have watched the market rise past their entry points. They are fine on paper, but those who purchased in 2022 and 2023 at peak pricing, with handover dates in 2025 to 2026, are now calculating yields in a market where supply is beginning to catch up to demand. The Dubai Land Department registered 177,000 real estate transactions in 2023, a record. Supply under construction is now the highest it has been in 15 years. When supply meets demand at the top of a cycle, prices do not collapse immediately. They stagnate. And stagnation, for a developer whose business model depends on perpetual appreciation, expectations to drive off-plan sales, is its own kind of crisis. The story of Emaar is not a story about bad management. Mohammed Al-Abar is one of the most capable real estate executives in the world. The company he built from a government directive into a $20 billion enterprise is a genuine achievement of the kind that business school curricula will analyze for decades. The story of Emaar is a story about a structural bet that was never fully disclosed in any prospectus. The bet was this: that the Middle East had permanently changed, that the combination of sovereign wealth, modernization programs, expatriate population growth, and Western capital seeking non-Western returns had created a new stable zone, a financial and residential safe harbor anchored by Dubai at its center, that the old Middle East, the one that burned and displaced and destabilized, was receding permanently into history. That bet was not irrational. Between 2010 and 2022, there were 12 years of evidence in its favor. Dubai did not burn, the UAE did not destabilize. The money did come. The towers did rise. The model did work. What October 7th revealed, and what the Houthi campaign confirmed, is that the stability was not structural. It was situational. It was the product of a specific alignment of interests among the US, the Gulf monarchies, and the Israeli security establishment that the Gaza war shattered in a single morning. No real estate company can insure against geopolitical rupture at the scale of what happened in October 2023. That is not Emaar's failure. That is the nature of systemic risk in concentrated geographies. What is Emaar's responsibility, and what its shareholders deserved more transparency about, is the degree to which the entire international expansion strategy was contingent on a peace dividend that was never guaranteed and never priced. The Burj Khalifa is 828 meters tall. It can be seen from 95 kilometers away. It was built on the assumption that what you could see from 95 kilometers away would remain stable long enough to justify the investment. The Middle East has a different answer for that assumption than Mohammed Al-Abar hoped. You can build the tallest tower in the world. You cannot build it above the reach of history.